At the rate I'm currently investing, by age 65, I will comfortably be basking in over $20 million. Yeah, you heard that right, 20 mil. And that's even after using more conservative numbers, which leads us all to the big question that we all ought to be asking ourselves right now, which is whether or not our current dividend investing strategy, or just generally speaking, our investing strategy is really the right fit for us to actually accomplish our financial end goals. And more importantly, are our current strategies really maximizing our ROIs to even achieve legitimate financial freedom at some point? Today, I am not only going to break down the insanely simple strategy to get to that $20 million+ retirement portfolio, but I'm going to go ahead and rough some of you up by challenging you all to really think about your current investing strategy and how to test whether or not it's really worth your actual time to continue with it. Before I get there, I just want to say this entire video actually was born from a recent Masters of the Market chat that I had with Gary Gill, a fellow creator, current millionaire, and just one heck of an outstanding guy. It was during that chat discussing the money mindset that will take you from $0 to the seven-figure club that had me really fired up to make this very video. Why? Because so many of us think we can actually do a better job than some of Wall Street's greats out there, which is just crazy to even say, because even the industry's giants from Ray Dalio to Warren Buffett and Munger all said this game of investing, whereas investors try to pick the stocks, the winning stocks that is 100% of the time, is really just a loser's game. And therefore, simplicity will very likely be your best means to building true, everlasting wealth. But first things first, I want you to understand that your current investing strategy might be doing you more harm than good. And it's time to test whether or not that's actually the case. Now, the test is pretty simple. That's all you have to do is really compare the performance of your portfolio's returns to a benchmark index like the S&P 500. Or if you're really questioning whether certain individual stocks even deserve a home in your portfolio, again, that's all you have to do is compare those stocks to the S&P 500's performance. Now, what exactly is the S&P and why is it a fantastic benchmark for all of us to be using? It's a market index tracking the stock performance of 500 leading companies listed on the stock exchanges within the United States. And if you're not beating it constantly year in and year out, it really isn't a good sign. Just have a look here. Over the last 5 years, simply investing into the S&P 500 would have crushed the results of some of the most popular dividend stocks out there that everyone is hyped up about for dividend income. But they fail to actually see that they're losing in the end of the day because it's about total return. Now, we have Realty Income, Altria Group, or the more conservative Coca-Cola and Procter & Gamble's of the world. As you can see right there in front of you, the S&P appreciated by over 94%, while the rest of these dividend gems, for many of us, just got smoked. Could your portfolio be outperforming the S&P right now? Sure, not denying that. And if that's the case, definitely go ahead and let me know down there in the comments. But chances are you're not doing that on a consistent basis, year in and year out, which is where the real problem lies. And with that said, we then should be questioning the S&P 500 itself and what makes it such a powerful investment machine. In my opinion, its power stems from the heavier weighted tech frontrunners like Apple and Microsoft to Nvidia and Amazon and Meta before it taps into stocks like Berkshire Hathaway, Alphabet, and Broadcom. And the list goes on from there. But right off the bat, you can certainly notice that it isn't exactly a strictly dividend-focused index, though it does pay a dividend. However, I would just argue that the vast majority of us, well, dividend income really shouldn't be the sole focus, depending on your investor profiles, which is what I'm always talking about, especially if you're in your 20s, 30s, or 40s. After all, the magic of investing stems from the compound effect, referring to a snowball effect or reinvesting earnings from an investment back into your original investment, leading to exponential growth over time. And time is exactly what younger investors have working in their favor to really enjoy juicy returns. It's important to note that the S&P 500, a return there on a year-over-year basis is about 10%, with some years like last year more than doubling that. And then we have other years that come in a tad below that mark. But because we are, or at least should be, long-term investors, knowing that never before has the S&P really seen steep losses and hasn't recovered, we just see that it keeps going higher and higher. So with that mindset, the only question we have to really ask ourselves is our current strategy really ideal for us? And if not, then you should definitely be doing some comparing. As for me, someone who does in fact hold individual stocks as well, because I do enjoy stock picking and actively keeping up with my investments as if I was running these companies, it's important to consistently outpace the S&P 500 when I pick these companies. And clicking into Blossom, which is where you can see my entire portfolio and all of my investment moves in real time. So there you go, link down there in the description for you if you want to keep up with me. But I have stocks like Apple and Alphabet, as well as dividend growers like United Health and Waste Management. They all have phenomenal track records of outperforming the S&P 500. I would encourage all of you to jump onto Blossom so you can further explore my entire portfolio and get a real understanding of my investor profile. But I've evolved over time as an investor to really realize the necessity, or the pivot rather, that I needed to take in order to get where I am today. For right now, we're going to use a Google stock chart just to see exactly what I'm talking about. And for those of you who will comment, yes, I know United Health isn't outperforming the S&P 500 right now, but as a long-term investor in this stock with a lot of conviction for it, keeping calm and patient, awaiting the big comeback in ROI. Either way, what you should really be taking away from this chart is the fact that individual stocks in my portfolio have been and likely will continue to outpace the S&P 500, which makes them worthy for my portfolio. Now, any stocks that don't have such a great track record of actually beating the S&P 500 wouldn't make the cut no matter how high those dividend yields are, because again, the great reality is I don't need that dividend income right now, nor do I want to be taxed up the wazoo because of dividends, which is also now what no one really talks about, but I will just save that for another video because I want to wrap up with a bit of a deeper dive on this $20 million retirement portfolio strategy. Ready for it? That's all it takes is selling out of every single position in your portfolio to go all in on just one single investment, and that's the S&P 500 itself, which will essentially guarantee me and you millions of dollars as long as we remain consistent with an ability to dollar cost average into the S&P 500 week over week or month over month, because ultimately at the end of the day, this is not a get rich by Tuesday type of deal, but the long-term marathon. But if you can remain consistent and patient while throwing everything you can into the one index, you can really be a millionaire by retirement. And I'm not kidding. So using a simple compound interest calculator, I want to show you firsthand what exactly is going on here. Jumping to investor.gov, I will just enter in my initial investment, which is currently my portfolio's value, so roughly $263,000 plus dollars. Come down to the monthly contributions, where I have been throwing in just about $8,000 a month. But for this video, I'm actually going to have that and keep it a little more conservative. And I will also enter in 35 years worth of a time invested, because that's how much I have left to go until 65, which is crazy to say. And then we're going to see here that we can simply plug in the S&P 500 average return rate, which is 10%, while we keep the compound frequency to just once per year. We're going to hit calculate, and then we're going to find that I would be sitting on north of $20 million. And now for all of you out there thinking that there's no way that you can even get close to that contribution rate, let's just make it more realistic for all of us. An initial investment of $10,000, doable. A contribution of $250 a month, which is totally doable. No excuses, really, no excuses. Let's say you are in your 20s if you're watching this, so maybe you have about 40 years left to go before retirement. And again, an average return rate of 10%, given that's the S&P's average annual return. This investor would be sitting on over $1.7 million. Now, is this the most thrilling investment strategy? No. But will it actually almost guarantee you millionaire status by retirement? Absolutely. And better yet, choosing to crush your ego by admitting that you can't always outpace the S&P 500 and investing directly into individual stocks won't exactly gift you perhaps what you're looking for, but the S&P will gift you with exponential returns over time, again, remaining patient and consistent. I'd say this is almost a no-brainer for more than half of us watching this video. Now, investors, what are your thoughts on taking this really humble approach to investing? Are you consistently outperforming the S&P 500? Are you not doing so great in the market and looking for a new strategy? I want to know, so go ahead and comment down below with all your thoughts. Be sure to tune into this video right here, where Marcus Mila and I actually discuss the power of leveraged ETFs for those of you who are really looking to double or triple your dividend income in some instances. And with that, I will catch you all in the next video.